Is this one of those times where the history is actually going to repeat itself? We're looking at some of the facts that took place right before the crash in 1987 and comparing it to the market conditions right now in 2018. As I'm going through the following video, try to answer the questions before I'm giving the answers. I hope you enjoy. Let's take a closer look. So, what exactly was happening to the dollar in the years preceding the 1987 crash? Was the dollar going up in value? Was it getting answer A? Or B, was the dollar getting increasingly weaker? The answer to that question, if we take a look at the 1987 dollar index historical price, as you can see, right before the crash, the dollar index was going lower substantially. As you can see, right around from exceeding the 100 level, it went all the way down to about 93. So the correct answer, the trend before the 1987 crash was a weaker dollar trend. How does that compare to 2017, 2018? Well, we're clearly seeing the dollar index currently is even below the 93 level, and looking at this chart, I was able to pull up right here for the last year roughly the dollar index have been going down as well, and it is under a critical level of 90. So very similar conditions as far as the weaker dollar trend. Question number 2. What was the trade deficit trend? Was the trade deficit increasing or was the trade deficit decreasing? The answer to that we can find in a couple of little areas here. U.S. trade deficit surges, making 1986 the worst year. Hopes for reversal are dashed. The national trade deficit surged to a record of almost $20 billion in November, reversing the 3-month improvement trend and making 1986 by far the worst year for the nation's trade, government officials said. Now, how does this compare to the trade deficit in 2018? Trade deficit hits all-time high. I don't think there's any surprise here. In December 2017 at $53 billion just for the month of December. And U.S. trade deficit in Trump's first year soars to 9-year high at $566 billion. So the correct answer was the trade deficit trend was increasing. What was the S&P price to earnings ratio, or actually was the S&P price to earnings ratio higher in 1987 or 2018? This is sort of a tricky question, a little bit, but let's take a look at the graph for 1987. There's different ways to calculate the PE. There's your regular PE, there's your forward PE. So depending on what PE ratio you're looking at, and how it's calculated, your PE for the year of 1987, right before the crash, could be, the answer to that could be anywhere from 18 to 25. Now, how do you think that's compared to 2018? Let's take a closer look here. Again, that number could vary. I have F18, which would be forward. If we do a forward PE, it would be at 18. If we look at the Schiller PE adjusted for inflation, it could be as high as 32. So again, it's anywhere from 18 to 32. So the answer here, they were about the same, or depending on which numbers you use, they're going to be significantly higher. The PE in relation to the 1987 level in 2018 is going to be significantly higher. So higher in 2018. What was the general market sentiment in 1987 before the crash? Was it bearish, B, bullish. C, extremely bullish. Well, forget all the dot-com boom irrational exuberance. The current sentiment eclipses all of that, and that actually the note pertains to the 2018 sentiment. In fact, the bullishness has never been this high, going all the way back to 1987. So we just discovered another pattern, another trend, another similarity that we find between a 1987 and 2018 market. Pure exuberance, investor sentiment hasn't been this high since two bubbles ago. And of course, the bubbles pertaining to the 2008 real estate bubble, to the 2000 dot-com bubble, and the major bubble before that, or the crisis or the crash, whatever you want to call it, was in 1987. So the correct answer would have been extremely bullish sentiment before the crash of 1987. How was the economic outlook? A, strong. B, certain. C, less certain. Well, let's take a closer look here. And this comes directly from the Security and Exchange Commission or Federal Reserve website. However, the macroeconomic outlook during the months leading up to the crash had become somewhat less certain. Interest rates were rising globally, a growing U.S. trade deficit, and decline in value of the dollar were leading to concerns about inflation and the need for high interest rates in the United States as well. As we can see, Goldman Sachs states that for the first time since 2010, the world economy is outperforming most predictions and only going to continue and amplify that in 2018. However, later in the note, they state that they hope that Federal Reserve will lean against the strength of the economy considerably, and they're expecting them to raise the rates. Now, the question is, we don't know how quickly the Fed will raise the rates. So in that sense, the outlook is also less certain, which is very similar to the 1987 situation. By the way, the interest rates were higher in 1987, but we're talking about the trend, and the trend was for the interest rates at that point in time to go even higher. Next question. What was the fiscal policy trend? Answer A, higher corporate taxes, higher personal taxes. B, lower corporate taxes, lower personal taxes. And C, higher corporate taxes, lower personal taxes. Let's take a closer look. Tax reform of 1986 lowered top marginal rate to 28%. It reduced top corporate marginal rate to 34%. Now, of course, Reagan campaigned in 1980 on reducing taxes, and during his administration, he was able to reduce certain taxes from 70% to 28%. But very interesting to notice that he, in the midst of doing that, at the same time, was also increasing certain taxes. How does that compare? Well, 2018, we all know permanent tax reduction for corporations, temporary reduction for individuals, however. And at the same time, Trump was and is trying to create other taxes, such as, for example, a proposed gasoline tax. So although it appears as if he lowered the taxes, he really lowered them for the corporations. Majority of the middle class actually will see a tax rate increase, and we may be seeing some other tax increases in the near future. So the correct answer is B, lower corporate, lower personal in 1987, and with the possibility open on raising other taxes throughout the presidency. What was the tariff policy in the years preceding 1987? Possible answer A, increased protectionism and tariffs. Answer B, decreased protectionism and tariffs. Reagan presidency, 100% tariff on Japanese automobiles plus tariffs on steel and even motorcycles. Does that sound even remotely familiar to you? How about this? Let's make America great again. Well, it turns out that Reagan was Trump's hero on protectionism. And he even used his campaign slogan. Exactly. So what do we have as far as tariffs? 25% on steel, 10% on aluminum, and who knows what other tariffs could be put in place in the near future. So the correct answer was high protectionism, high tariffs. What was the monetary policy trend and the interest rate environment in 1987? Lower interest rates or increase interest rates? Well, the four pillars of Reaganomics were to reduce the growth of government spending, reduce the federal income tax and capital gains tax, reduce government regulation, and tighten the money supply in order to reduce inflation. During Reagan's presidency, the national debt almost tripled, and the United States went from being the world's largest creditor nation to the world's largest debtor in under 8 years. You think this is a pretty good description exactly what's happening right now and where the United States is headed? As a part of a tighter monetary policy, it is typical to see an increase in interest rates, so the answer would be B to this question. In 2018, the Federal Reserve is on track to raise interest rates 3 or 4 times, and in just 2 days, on March 21st, I think we're going to see the next rate hike. Now, the main theory, of course, of the stock market, and during any time throughout the history, rates go up, stock markets come down. Interest rates will also affect different areas of business. For example, Fed rate hikes expected to hurt car sales in 2018 because of the abundance of cheap financing available in the prior years. Analysts see the demand drop in 2018 despite the strong economy. Next question, what was the budget deficit trend? A, budget deficit increasing, B, budget deficit declining. Let's see what's going on here. Federal budget deficit hit record high of $220 billion in fiscal 1987. What is also notable is that the unending series of record high deficits have been the hallmark of American fiscal policy in the 1980s, said Harvard economist Benjamin Friedman. It has had a serious depressing effect on business capital formation and on the trade deficit. Fast forward to 2018, as deficit soars toward $1 trillion, Congress shrugs and keeps spending. Now, this is what's notable. The U.S. government recorded a monthly budget deficit of $215 billion in February. That figure is actually higher than the entire annual budget deficit for the year of 1985. Next question. What was the trend of budget deficit to GDP ratio? Was it increasing or B, decreasing? Well, let's take a look at the numbers. $185 billion deficit in 1984, $212 billion in 1985, $221 billion, the increase of 4.5%, 4.8%, 4.8% due to tax cuts right here. And then what do we see in 1987? Leads to the ultimate market crash. So the increase of budget deficit to GDP ratio consecutively over a few years could be a sign of a common market crash. So let's take a look. In comparison to 2017 and 18, we have a similar pattern where continuously the budget itself is, the deficit itself is growing from 485, 438, a little drop here, to 585, huge gain, another huge gain to 665, and is estimated to be at 833, but apparently it is going to already exceed this figure. So what do we have here? A possible crash just on the horizon. Next question, make it very easy for you. True or false? The graph trend line of S&P 500 and Dow Jones in 1987 and 2018 are almost identical. Let's take a closer look. Here's the Dow Jones. Got this beautiful uptrend. Look at this. Wow, look at this beauty right here. Uptrend here touches the trend line, bounces back, keeps going higher. Huh. Whoa, didn't we just have this in February 2nd, February 9th? Very interesting graph. Hold on, are you sure it was in 87? Yes, it was. My goodness, this looked like a February graph of 2018 here. Okay, so let's compare that to S&P 500. Similarly, very beautiful uptrend, very beautiful uptrend. Whoa, what do we have here? Wow, how close is this? Look at that. Absolutely incredible. So, what exactly are the causes to blame for the crash of 1987, and maybe what exactly intensified the crash of 1987? Could it maybe been a smaller crash? Well, I think we're looking at the usual suspects here. The usual suspects being, of course, maybe you can guess, at least the first one here. What is the common denominator in every crash throughout the United States history? There is one common denominator that is present at every crash throughout the history. Take a wild guess before I slide lower. Come on, I know you know it. Margin debt was at all-time high in 1929. It certainly was at all-time high again in 1987. It was at all-time high in 2007 before the market crash in 08. Look at this. Officially, the largest margin debt. And for those of you that may not be familiar with the term, margin debt is like when you go and you buy a bunch of stocks with money that you don't have. Well, what could be a good example of that? Like buying Bitcoin with a credit card for $18,000 and then wondering, should you still hodl when it's trading at $8,000? So that's basically what margin debt is. Now, the problem is actually much bigger than what appears, and I'll get to that in just a second. The second reason is 1980s, of course, sort of the decade where the computers were coming out, and so the second reason they were blaming it, the market fall, was on the increased computer participation, program trading strategies. And the third reason was the derivatives, like your index options on S&P. They were traded in Chicago. The cash trading on equities was happening in New York. So there was a discrepancy in the information, and it was the poor functioning of getting the correct data between the two that made it very difficult for accurate trading because not all the stocks were open over the course of the few days when the crash was happening. I'll actually do a separate video on that, going into detail about this, so stay tuned, subscribe to the channel. But let me show you this last slide. Very, very important question. What has actually lifted the stocks from the 1987 crash low? And the possible answers are A, the Fed interference, B, stock buybacks, C, both. Well, of course, the Fed stepped in and provided the liquidity. Actually did make the matters worse because they talked about pausing the trading, the market freaked out. So there were some things that they did trying to intervene that actually made things worse. But they did provide the market liquidity. They lowered the rates, the short-term rates. They funded the banks. So the businesses were able to loan the money and continue trading. So they did provide an important role in that. However, the market did not start rebounding until this announcement was made right here. Later in the afternoon that pertains to the October 19th, Monday, there was a sustained rise in financial markets as corporations announced stock buyback programs to support demand for their stocks. Corporations had started announcing these programs Monday afternoon, and it was not until partway through Tuesday that the critical mass has formed. Now, clearly, stock buybacks in this particular case were able to hold the market artificially without letting it drop further. Now, did you know that actually until 1982 stock buybacks, they were prohibited. They were considered to be market manipulation. And so as they served an important role in the 1987 crash, the current situation with stock buybacks, because of the low interest rate environment, is becoming to be a huge hazard for the markets. And I see that in the near future, in the next couple of years, that stock buybacks may be prohibited again. They serve no productivity purposes, for the economy. In other words, they don't create extra jobs. So with tax cuts right now, what you see a lot of companies, instead of using the tax cut money to go and expand their business and grow their business or grow the efficiency of their business or open in another department or, and hire more people or, spending more money on research and creating jobs that way, what a lot of companies are doing, they simply go, and there's some tax advantages involved in that as well, similarly to how there were certain tax advantages in the 80s for doing leveraged buyouts of companies. So every time there's a tax benefit involved to the company and they can take advantage of it legally, they're going to do it. But at a certain point, it becomes a huge issue. And I came across a good article at Zero Hedge, and I wanted to share with you guys. Here's what they discovered. International Monetary Fund estimates suggest that the large U.S. corporations have experienced a negative net equity issuance of $3 trillion since 2009 due to share buybacks, thus sufficiently boosting the equity leverage ratio. That's from the International Institute of Finance. In other words, corporate have less equity and more debt now. Exactly what one should expect if companies issue debt and buy back equity. Now, for example, Apple, which previously did not have any long-term debt, issued $100 billion to buy back shares and waits to repatriate $269 billion in cash sitting around. They give a couple other examples about Microsoft and IBM. The whole process is convenient for companies because equity is more expensive to finance than debt in a zero-interest environment. And it artificially boosts earnings per share by keeping earnings the same, but reducing the number of shares. Now, of course, the interest rates are about to take off. They're about to rise. What's going to happen in the rising interest rates environment? The market is going to drop. The economy is going to slow down. The companies will be forced to liquidate their shares. They're not going to be able to make their loan payments. Okay? They're not going to be able to refinance these loan payments when they were borrowing money against these shares at next to nothing interest rates before. Well, now the value of the shares could be significantly lower. They're not going to be able to secure the loans at the same low interest rate. They're going to have to borrow at a much higher rate. They're going to have to make the payments. They're going to be forced to sell the shares. The oversupply in the market is going to continue to drive the share prices further flow. Especially in a tight economic environment, it won't be long until companies start selling shares again at much lower prices this time just to survive. The biggest companies in the United States run the risk of ending up like speculators caught in the margin call. Yes, just like in the movie, just like in 1929, just like in 1987, just like in 2007 and 8. The only thing, this time, it could be much, much worse. So the question is, what do you do? If you'd like to know how to protect your assets, how to make money, so you wouldn't be caught up in a situation like 2000, so you wouldn't be caught up in a situation like 2008. Learn how to make money by shorting stocks, by buying put options. I know you're going to go listen to some other videos out there and they're all going to tell you one thing: go buy gold. Well, guess what happened? During the last market drop, the gold tanked along with everything else. Yes, you can make a bullish case for gold, of course, but you shouldn't be cashing everything out and putting everything in gold. That's sort of more of a preservation strategy, where you try to preserve your capital, where you try to preserve your assets. I'm talking to you about an opportunity to prosper. If you're interested in knowing how to take advantage of the market crash before it takes advantage of you, please visit marketcrash.money. Marketcrash.money. Click right here on how to profit. Whether you're a brand new trader or an experienced trader looking for fresh, new ideas on how to profit in this brand new, high volatile market environment, schedule your consultation by clicking right here on how to profit. You're not going to be in a webinar with 100 other people. This is a one-on-one consultation that focuses specifically on your goals. We specialize in trading weekly options, monthly options, 6 months options, 1 year options, and all the way out for long-term investors that may be listening right now. We specialize in options going all the way out 2 years in expiration. So don't wait till tomorrow. Take action now. Again, March 2018 could be the beginning of the next crash, because the crash of 1987 did not just happen on October 19th. It was actually preceded by substantial moves lower over the course of the few days. So this could be the first day of the crash. We will find out by Friday, but I encourage you to take action now. And if you're not convinced entirely why you should, please tune in and watch a few episodes that I was able to find from 1987, right before the crash. I hope you enjoy. I'll catch you on the next video. Thanks for watching.
That the bull is dead. Marty Zweig is one who has been correctly worried about this market lately. Do you agree with that comment?
Yes. But I haven't been looking for a bear market per se. I've been really in my own mind looking for a crash, but I didn't want to talk about it publicly because it's like shouting fire in a crowded theater, and there's other ways to play it. You just tilt your strategy negatively and you shut your mouth. And I think we're in the middle of something reminiscent of 1946 or 1962, which were very similar, and to some extent 29, but it won't be as bad. And I think we're in the middle to somewhat beyond the middle of this break. And there'll be some violent rallies, though. In fact, probably early next week, I expect a violent rally.
But that would not change your long-term estimate that the bull market's over.
Well, I don't look for a long bear market here. I only look for a brief decline, but a vicious one. In 1962, the damage was done in 2 months. In 1929, it was done in, mostly 10 weeks. And I don't think it's going to drag on any longer than that here, but just will go down more and then turn around.
Some people say it's a bear market if you're off as much as 20%. We're nearly there now. What's your definition of it?
Well, it would be a bear market, but I think of a bear market 1973, 74, where it's drawn out for quite a while, whereas a crash is something like 46 or 62 that's over in, say, a month or two. That's, to me, the difference.
How should people play it?
Very cautiously. You're going to be hurt no matter whether you're bullish or bearish. There's too many traps to fall into. We should have a selling climax and probably 2 of them. And after a selling climax, they always go back lower. So we're probably going to have, I'd say, 3 gigantic rallies within the next month or so, and every one of them could be a trap. Except the last one, of course. But whenever that comes, you don't know. It's hard.
Very thorough. Marty, in his affable way, has used that nasty word crash. Do you accept that estimate?
No, and I wouldn't accept the estimate that the bull market is over either. Certainly we're in a correction, and that's been more than obvious. And I think you have to remember here that we're not dealing with real buyers and real sellers making real buy and sell decisions like in the old stock market, because you do have this computerized program trading and portfolio insurance really making these very extreme, very rapid decisions.
May I ask you a question about that?
Yes.
These computers are used by large institutional investors whose money managers are paid huge sums of money to make no-brain decisions that are made for them by computers. Aren't these guys overpaid?
I don't think I want to answer that one.
I think you just did. Tell us why you don't think the bull market's over.
Well, I think interest rates are the real key here. At these levels, we'd have to see some interest rate relief to see the bull market continue into another leg. And I don't think that's out of the realm of possibility. We could see some rate declines by next year, and that would certainly be a positive. At these levels, though, I would agree with Marty, we're in for some rough sledding, and the risk here really is that interest rates don't give you that relief, and then you would continue with more of the same.
Extreme negative, one reassurance. How do you vote?
Well, I'm more positive, I think, than either Marty or Mary, in that I think that we've probably had 90% of the decline. I think it's possible we could go lower here over the next week or so, but I think sometime between now and maybe the end of the year or the end of the first quarter, that you'll see the market in excess of its recent highs.
What do you base that on? Why do you disagree
Well,
with that?
I would agree with Mary in that I think we're due for a rally in the bond market. And I think we will see some improvement in terms of the trade numbers as we go forward here. And corporate earnings, I think, are going to get better as we go forward also. So I think that interest rates probably are the key to the extent that through the first half of the year, or really through the first 9 months of the year up until recently, the bond market and the stock market had moved in an inverse relationship. Now I think you will see somewhat more coupling of the two. And I think that interest rates probably will rally sometime over the next several months, and I think we'll enjoy a nice recovery when that occurs.
Let's hope we're all still. What sort of signals does a week like this past one send to your forecast?
They're very serious. The signs and the symptoms that the financial markets are giving off are of a very bad problem for our markets and our economy, and have to make me much more worried about the economy for next year.
Have you changed your economic forecast as a result of this week's action?
Well, the extraordinary levels of interest rates, even at these rates of inflation, and the tremendous decline in the stock market are symptoms of both huge budget and trade deficits, tremendous amount of financing, and no one can say for sure how high interest rates have to go in order for that to occur. And the result of this much problem on interest rates, 3 percentage points higher this year, and of the big declines in the stock market have to be much more damage to our economy and raise the risks of a recession next year.
Give us a forecast for each of those 3 interest rates we just saw. What do you expect to happen? T-bills, munis, T-bonds?
Well, over the next 2 or 3 weeks...
over the next year.
Over the next year, on average, they should move higher. We are later in the stage of the business expansion. And we should see long bonds, and there will be respites, there will be some periods of improvement, but between now and then, another point and a half on long-term interest rates, with much higher short-term rates in the interim.
You quite recently said you didn't expect a recession next year, and now you're raising that specter. What point next year, and what odds do you give it?
Well, up to now, at least until April of this year, I thought the odds were 1 in 10 of a recession before the end of 1988. Starting in April, I thought those odds were 1 in 4. And now I'd have to say that there's a 1 in 3 chance. The odds are still good that we'll get through it, get through 88 into 89, but the risks are growing almost by the day. And 89 looks more risky even than 88.
What could we do to avoid the forecast you've just made coming true?
Well, at a certain stage in the business expansion, there's only one forecast on interest rates. On average, they have to move higher irregularly as inflation moves higher and as the business cycle moves to, business expansion moves to an end. And the only way to avoid that is through a major slowdown or a recession. It is the only other way is for inflation rates to go a lot lower than 4 to 5%, back to 3 to 4%. Another possibility would be a breakthrough in the budget deficit, more than Washington has done on the Gramer-Hollings fix, substantial improvement in the trade deficit, much weaker economies overseas, or interest rate relief from overseas. If you run through each of those, right now, none of them look very probable.
They're going to let them mature. They're not going to roll them over. So that means the Treasury has to find an alternative, a replacement buyer for those Treasuries. Well, who's going to do it? Now, China, there were already rumors like a week ago that China is finished buying dollars, that they don't want to buy them anymore either, or treasuries, which means they're going to do the same thing as the Fed. But of course, if the Central Bank of the United States doesn't want to buy any more treasuries, why should the Central Bank of China want to buy them? Right? It makes sense. Now, they came out with a rumor denying that, but I read the denial, and you know what? They really didn't deny it. So to me, you know, where there's smoke, there's fire. Plus, why the hell would the Chinese want to buy any more treasuries? So if the Chinese aren't buying treasuries, you know, the Japanese and the Chinese are the two biggest foreign creditors. Japanese don't look like they're buying them anymore either. So I don't think there's any real buyers. I just think there's sellers. I think that we're going to break the downtrend. This big bull market, this 30 whatever year bull market, the bond bull market started, believe it or not, probably in the early 80s. And we've had cyclical declines, but yields in general have been coming down for all that time. That's about to change. Yields are now going higher, much higher. But here's the problem: America's broke. America has more debt than ever before. The national debt is getting closer now to $21 trillion. In 2008, it was what? Not even $10 trillion when we started the financial crisis. So the debt has more than doubled since the financial crisis. Why do we have a financial crisis? Because we had too much debt. Well, now we have much more, right? And it's not just the federal debt that's gone up. American individuals are in debt more than they were back then. They have more credit card debt, they have more student loans, and they have more car loans. We don't have more mortgage debt, but that's because home ownership is at a 50, 60-year low. So you can't have a mortgage if you don't have a house. But people don't have the home equity that they had. I mean, people are broke. People are living paycheck to paycheck in the United States. So we can't withstand rising interest rates. What has really been propping up the U.S. economy is cheap money and cheap gas, right? Because oil prices collapsed, a few years ago, and that gave everybody a boost. And we've had all this cheap money that has been able to prop up the government, the economy. But that goes away. That's it. I mean, interest rates could move up very quickly, right, and by a large amount. But because we have so much debt, that is an enormous amount of money. I mean, think about what it does to the federal budget alone. So if interest rates move up, the deficit skyrockets, right? But here is the self-perpetuating spiral that we're in. As the deficits go up, right, now we have to sell more bonds. Well, that puts more downward pressure on bond prices and more upward pressure on interest rates. So as rising interest rates create bigger deficits, those bigger deficits create rising interest rates. It just keeps going on itself. The same thing with the dollar. The more bonds the Treasury wants to sell, the more dollars the Federal Reserve would have to create if it wanted to buy them to prevent that rate increase.
See, right now it's not even talking about doing that. Right now it's saying it's going to sell bonds. But it's going to have to reverse. Because if it does nothing, interest rates keep going up. And what's that going to do? That's going to crash the stock market. That's going to crash the real estate market. That's going to cause another